France has the highest share of government spending in the world. At 57% of GDP, the government is the biggest part of the economy. The French state has become a very generous pension provider, but increasingly without the means to pay. In terms of increasing debt, France is edging ahead of the UK with a faster rise in recent years. But whilst the UK fret about the growth in pension spending, which is very real, France is in another league. If you include off-balance sheet debt from pension promises, French debt is 400% of GDP. In the euro, there was supposed to be a target of 60% debt to GDP, though everybody has quietly forgotten that inconvenient target. The last time the French ran a budget surplus was in 1980, and in recent years the deficit has been stubbornly difficult to reduce, only getting higher if anything. A big driver is the ongoing pension deficit. The French have the longest retirement in the world, nearly 25 years, more than 5 years than a typical American. A typical French pensioner gains more income than the average worker. It is the only place in the world where this happens. If you look at government spending on pensions, France is the third highest in the world, much higher than, say, the United Kingdom. But there are even more problems. French public sector pensions are entirely funded through pay-as-you-go. There is none of a typical investment in a pension fund, which gives you better returns and the money to pay those future pension guarantees. French pension benefits are also deeply embedded in the national psyche. When the French government wanted to raise the retirement age from 62 to 64, there were bitter protests which continue today, even though at 64 it's still one of the lowest retirement ages in the world. Now, there are very good reasons to keep a good work-life balance. For example, if we compare GDP per capita, it seems that the United States is 20, 30, 40% better off than European countries. But it does come at a cost of working longer hours, shorter holidays, and shorter retirement. The United States also has a significantly lower life expectancy. You may have more money in the United States, but less time to spend it. And if you adjust GDP per capita for quality of life, it's a very different story comparing Europe and the United States. The desire to have a good retirement and a welfare state is very reasonable, but it is possible to have too much of a good thing. The problem is that as the baby boomer generation retire, France is facing a huge pension deficit that's bankrupting the country and taking money away from other services. For example, pensions consume 30% of the French education budget, more than is invested in primary or secondary education. The need to pay pension commitments is undermining the ability to fund other public services. The French government may be spending 57% of GDP, but there are still growing complaints about cutbacks to rural train services, longer hospital waiting lists, less spending on infrastructure. Now, whilst pension benefits are politically difficult to touch, one option pushed forward is a new wealth tax. For example, a 2% wealth tax on fortunes over 100 million euros, which some economists suggest could raise 20 billion euros a year. But even assuming it doesn't cause the rich to leave France to move to Belgium or Monaco or something, 20 billion euros is still a proverbial drop in the ocean compared to annual pension spending of 350 billion a year. And there's also an issue of intergenerational fairness. The post-war baby boomer generation generally paid just a small proportion of their salaries to finance generous pensions and then voted to lower the pension age. But because pensions were pay-as-you-go with no investment, tax rates have had to continuously rise in recent decades to meet those past commitments. People currently retired in France end up with a pension pot containing double their past contribution, much more than the future generations can ever hope to receive. Le Monde reports that 16% of young French people aged 18 to 29 live below the poverty line. Housing is expensive, forcing young people to live in cramped shared housing. In 2023, when many workers saw their wages rise less than prices, the government increased pensions by 5.3% to offset inflation, which came at a budgetary cost of 14 billion euros. As Le Monde said, in France, the old are nearly kings. Like every European economy, France is ageing. In 1981, there were 5 million pensioners. Today, there are 17 million. And by 2050, there will be 23 million pensioners. That's a big political bloc. But it is not possible to keep the past pension generosity for future generations. It only happened in the past because of rapid economic growth and a rising tax burden, but that's reached its limit. France has one of the highest tax rates in the world, and if you kept increasing that tax burden even more, it would increasingly squeeze the private sector of the economy, which would provide much of the economic growth, investment and future tax income. Now, Japan's experience of aging is that economic growth rates tend to slow down as society ages, hardly surprising. And it's really hard to see any kind of economic miracle causing a boom in tax revenues to meet pension demand. That's really wishful thinking. It means that France faces a familiar doom loop of rising deficits to pay pension commitments, which then in turn causes rising debt interest payments. And these have risen rapidly in recent years, because since 2021, the cost of borrowing has risen rapidly. Now, this partly reflects a global trend to higher bond yields, but it also does reflect market unease at the long-term French budget situation. Credit rating agencies are considering downgrading France, and all the political instability and apparent political impotence only makes the French situation appear worse. And ironically, in the reversal of a Eurobond crisis, French bond yields are now higher than Spain, Greece and Italy. But against this alarmist portrayal, it is worth pointing out a few things. Firstly, the situation is fixable. It's not a lost cause. French inflation is low. France has largely financed their current debt through domestic savers, unlike, say, the UK, which increasingly relies on overseas buyers. And currently, France has no problem raising finance. Bond yields have gone up, but they're still manageable. Also, you could say that in the euro, France could benefit from the ECB's new policy to do whatever it takes to avoid a bond crisis. Since 2012, the ECB have generally brought down bond yields and staved off any crisis. But France is on a very different magnitude to Greece, and being in the euro could even be a liability. The ECB is not the French National Bank. Any ECB bailout would be contingent on things like enforced spending cuts and structural change. And also, the problem with France is not about liquidity shortages. The problem is a basic trajectory that spending will continue to increase much faster than revenue. Now, often fears of debt can be exaggerated, but it is also fair to say that the worst kind of government borrowing is to fund pension welfare spending as your population ages, tax revenues going down, spending goes up. It offers no investment in economic growth. And if French debt continues to rise, it will be like slowly boiling a frog in the water. For many years, it may well be manageable before it starts to become intolerable. But by then, it becomes very difficult to fix. It is worth saying it's a mistake to only focus on pensions. A French Senate committee found France spends $211 billion a year on subsidising business in an effort to support firms and industries. And the backdrop of the French economic difficulties is wider issues around the European economy, a heavy cost of regulation and a difficulty in competing with US big tech and Chinese exporters. France does actually have some advantages. It's got a wide-ranging economy with efforts to have its own AI, pharmaceutical, car industry, even with its own space program. In fact, France could benefit from a EU-wide renewal, reduced regulatory burden and greater European integration on taxes and industrial support. Now, back in October 1789, the price of bread in Paris doubled, meaning a loaf of bread took 80% of a worker's income. The oppressed French workers marched on Versailles to overthrow the corrupt government. And the ensuing French Revolution changed the world. Today, the French are protesting something just a bit different. But if France was to default on its debt, it would be a huge shock to the global economy. But that's a story for another day. Thanks for watching. Do subscribe and see you soon.